Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Vertiv Holdings Co. annual report. Vertiv Holdings Co. offers a wide range of businesses and services that cater to various industries. At the core of its offerings are critical digital infrastructure technologies, including AC and DC power management products, low/medium voltage switchgear, busbar, thermal management products, and integrated modular solutions. The company's product portfolio also includes racks, single-phase UPS, rack power distribution, rack thermal systems, configurable integrated solutions, energy storage solutions, hardware and software infrastructure. These technologies are integral to various services such as artificial intelligence, e-commerce, online banking, file sharing, video on demand, energy storage, wireless communications, Internet of Things, and online gaming. In addition to its product offerings, Vertiv provides lifecycle management services, predictive analytics, and professional services for deploying, maintaining, and optimizing its products and their related systems. These services include preventative maintenance, acceptance testing, engineering and consulting, fluid management, performance assessments, remote monitoring, training, spare parts, and critical digital infrastructure software services. The company serves its customers through a network of direct sales professionals, independent sales representatives, channel partners, and original equipment manufacturers. With a global presence in the Americas, Asia-Pacific, Europe, the Middle East, and Africa, Vertiv is well-positioned to meet the growing demands of the digital economy. The stock price of Vertiv Holdings Co. (VRT) has skyrocketed by over 113.59% in the past year, driven primarily by strong financial performances and surging demand within the data center market, particularly related to artificial intelligence (AI) infrastructure. One key factor contributing to this significant increase is Vertiv's robust earnings reports throughout 2025. The company consistently beat analyst expectations across all 4 quarters of 2025, with impressive year-over-year growth in net sales and non-GAAP earnings per share. For instance, in Q1 2025, Vertiv reported a 48.8% year-over-year increase in non-GAAP earnings and a 24.2% year-over-year rise in net sales. The strong demand for data center infrastructure, particularly AI-related solutions, has been a significant driver of Vertiv's growth. The company has highlighted robust momentum in the data center market, with increased investments in AI infrastructure being a key factor contributing to its sales and orders growth. This trend is expected to continue, as Vertiv provided an optimistic outlook for 2026, projecting continued high double-digit growth in net sales and adjusted diluted EPS. In addition to its strong financial performances, Vertiv has also been actively pursuing strategic initiatives and partnerships to capitalize on market opportunities. The company has initiated guidance for Q1 and full year 2026, indicating increased investments in research and development, ER&D, and expanding production capacity. It has also collaborated with Oklo Inc. to co-develop power and thermal solutions tailored for data centers, enhancing energy efficiency by leveraging heat from advanced nuclear power plants. Overall, Vertiv's strong financial performances, surging demand within the data center market, and strategic initiatives have all contributed to its significant stock price increase in the past year. Vertiv Holdings Co. market capitalization of $90 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Vertiv Holdings Co. holds a significant advantage in their industry. Vertiv Holdings Co. trades at a higher price-to-earnings ratio of 69 times and a higher price-to-book ratio of 22.76 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 73% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline for a company can be attributed to several key factors. Revenue growth is primarily driven by an increase in sales from agreements with multiple performance obligations recognized when tangible products are delivered. This indicates that the company's ability to execute on its contracts and deliver value to customers is a significant contributor to its revenue growth. On the other hand, potential risks of revenue decline include the significant increase in provision charged to expense for accounts receivable and inventory obsolescence. This suggests that the company may be experiencing difficulties in collecting payments from customers or managing its inventory levels effectively. Additionally, product sales growth varied across regions, with an increase in the Americas region but a decrease in the Asia-Pacific region. The decline in services and spares revenue by 18% also indicates a potential shift in customer demand or preferences. Overall, the company's revenue growth and decline are influenced by a combination of factors, including changes in sales execution, customer behavior, and operational efficiency. The net income of a company underwent significant changes between 2024 and 2025. Initially, it decreased in 2024 compared to 2023, but then experienced a substantial increase by $837 million, 168.8%, from 2024 to 2025. This resulted in a net income of $1,332.8 million in 2025, which is a notable improvement over the previous year's figure of $495.8 million. However, there seems to be an inconsistency in the data, as it also states that net income decreased by $136 million from 2024 to 2025. Despite this discrepancy, the overall trend indicates a significant increase in net income for the company. In terms of profit margins, the gross profit margin showed a slight decrease from 36.6% in 2024 to 36.3% in 2025. On the other hand, the operating profit margin increased from 33.7% implied in 2024 to 33.8% in 2025. The net income margin also experienced a notable increase from 6.2% in 2024 to 13% in 2025. The mixed results of profit margins suggest that the company's financial performance is complex and influenced by various factors. Despite some inconsistencies, the overall trend indicates an improvement in the company's financial health, particularly with regards to net income. The company's financial performance is a positive indicator of its ability to generate cash from its core operations. According to the provided data, the company has been generating significant operating cash flow in recent years. In 2025, the company reported an impressive net cash provided by operating activities of $2,113.8 million, indicating a substantial increase from the previous year's figure of $1,319.3 million. This trend is further confirmed on page 66, where it is stated that the company generated $2,113.8 million in net cash from operating activities in 2025. The data also shows that the company has been steadily increasing its operating cash flow over the years, with a notable increase of $794.5 million between 2024 and 2025. This significant growth is a testament to the company's ability to manage its operations efficiently and generate substantial cash from its core activities. In conclusion, based on the provided data, it is clear that the company is generating positive operating cash flow, which is a crucial indicator of its financial health and stability. The company's debt level and interest expenses have undergone significant changes over the past few years. On page 44, it is noted that the term loan due 2032 has increased by $1,226.10 from the previous year, while the senior secured notes due 2028 remains unchanged at $850. However, on page 45, no significant changes are mentioned in debt level or interest expenses. The borrowing rate for the term loan also saw a decrease from 6.19% to 5.61% between December 31, 2024 and December 31, 2025. In terms of interest expenses, there has been a downward trend over the years. According to page 63, the net interest expense decreased from $150.4 million in 2024 to $86.1 million in 2025, representing a decrease of 43%. Similarly, on page 66, it is reported that the interest expenses decreased by 18.8% from 2023 to 2024 and increased by 19.1% from 2024 to 2025. The ABL revolving credit facility also saw an increase in its capacity from $600 million pre-Amendment 8 to $830 million post-Amendment 9, as noted on page 90. Overall, the company's debt level and interest expenses have undergone significant changes over the past few years, with a notable decrease in net interest expense and borrowing rate. The financial performance of various segments and regions has been analyzed based on the extracted summaries. The Americas region stood out as a top performer, with net sales increasing by 41.9% and operating profit rising by 56.2%. This significant growth is also reflected in the net sales figures for 2025, which account for 62% of the total at $6,351.9 million. Product sales also saw a substantial increase of $1,961.8 million, indicating a strong market demand and effective product offerings. In contrast, there are no explicit mentions of regions or segments that performed poorly. However, it is worth noting that Asia-Pacific, Europe, Middle East and Africa, emerging markets, and established markets do not have specific performance data available, suggesting that their performance may be less clear-cut or require further analysis to determine their standing. Management at Vertiv is optimistic about the company's future prospects. They believe that the company is supercharging data's potential by accelerating technology and redefining densification limits, P7. Despite a flat enterprise market over the past 3 years, the commercial and industrial space is growing due to increased demand for intelligent infrastructure, P9. To capitalize on this growth, Vertiv plans to continue investing in global capacity, expand its solution capabilities through strategic acquisitions, and increase investment in AI infrastructure and thermal management, P41. The company also aims to strengthen its services capabilities and pursue partnerships to enhance technology capabilities. The outlook is particularly positive in the Asia-Pacific region, where growth is driven by expansion throughout the area, P44. Vertiv's financial results are expected to be driven by critical estimates such as forecasted earnings before interest, taxes, depreciation and amortization, as well as customer attrition rates and royalty rates, P46. The company has a strong cash position, with net cash provided by operating activities increasing by 60% in 2025 compared to 2024, P66. Vertiv is also investing in its business, with capital expenditures increasing by 31% in 2025 compared to 2024. In addition to these strategic initiatives, the company has made significant investments in acquisitions, including the acquisition of PurgeRite, which is expected to enhance the company's liquid cooling offerings and deliver end-to-end thermal management solutions, P78. Overall, Vertiv's management is confident in the company's ability to drive growth and innovation in the intelligent infrastructure market. The company has a history of paying dividends to its shareholders. This is evident from the records provided, which show that dividend payments have been made on November 29, 2023, at a rate of $0.25 per share. The total amount paid out in dividends was $24.4 million. In addition to paying dividends, it can be inferred that the company has not engaged in significant share buybacks, as there is no mention of such activity in the provided records. This suggests that the company's focus has been on distributing profits to shareholders through dividend payments rather than repurchasing shares. Concerns about inventory buildup and supply chain disruption are evident in the extracted summaries. On page 8, an estimated combined order backlog of $15 billion as of December 31, 2025, suggests potential inventory buildup. Furthermore, pages 10 and 19 highlight possible critical part shortages and oversupply, which could result in excess or obsolete materials. The issue of supply chain disruption is also a concern. Page 10 mentions logistical issues that may delay receipt of materials, while page 19 notes volatility in raw material prices and availability. Additionally, pages 20-22 discuss disruptions to IT systems, independent sales representatives, distributors, and original equipment manufacturers' markets or operating models. The data on inventory levels is also alarming. Pages 74 reports a 17% increase in total inventories from $1,244.40 to $1,456.50, with finished products inventory increasing by 38% and raw materials inventory increasing by 21%. These figures suggest that the company may be facing challenges in managing its inventory levels. The imposition of U.S. tariffs and retaliatory tariffs on page 40 could further exacerbate these issues, increasing costs and impacting financial performance. Overall, the concerns about inventory buildup and supply chain disruption are significant and warrant attention from management to mitigate potential risks. That concludes the financial summary for Vertiv Holdings Co. Feel free to comment below, and I will be happy to answer them when possible.